Welcome back to New Money. This evening we're discussing investments. My guest is Henry Biddlecombe. If you'd like to email me, you'll get my details on the screen. Henry, let's just talk about America. 1 month's time, we've got an election, and I know it's very difficult. Maybe you've got to take out your crystal ball. I see your beautiful wife's brand on her shirt. Love it, PP, but maybe it looks a bit like a crystal ball. So maybe you can share with us.
Let me rub it.
What's going to happen? Either way, what is the expectation if Trump gets in? What's the expectations if Harris gets in?
Look, I think let me preface my answer by first saying that I think there's very little margin for error in the US equity market. It's expensive. You know, the PE ratio is well above the long-term mean, and that's on the back of earnings growth estimates, which I think are very optimistic. So if anything does go wrong, the market could very easily correct by 15 or 20%. Having said that, I obviously can't predict the election results. By all accounts, it looks to be quite close. If I were a betting man, I would say Trump takes it. In the event that he does, obviously, he has. He talks about lower tax rates. He talks about import tariffs on China. He's very protectionist. He wants to revive the manufacturing sector in the States. So at the margin, I think all of that is incrementally growth positive for the States, not necessarily incrementally growth positive for the world. If you remember Trump's previous term and the kind of negative growth sentiment that came out on the back of his kind of antagonism towards China. But if we look at Kamala, there you're looking at continuation of the continual widening of the deficit in the US, should we say. A huge amount of government spending, which the US government can little afford, really. If you look at their interest payments every year, it's a bigger and bigger part of their budget. I think now the biggest line item in their budget, and that's growth negative for the States. So, what am I saying? On balance, I think Trump will be better for the US equity market and Kamala worse. But to the extent that there are surprises, there's no margin for error. So we can see big moves, probably to the downside.
When you say no margin for error, you talk about company results, and we've now got in this month we're going to get reporting on third quarter out of the USA. Your expectation there? Do you think that companies will still continue to show growth?
Yeah, I think so. But, as we progress into next year, the hurdles that these companies need to clear are high. I mean, let's look at the Mag 7, the big 7 stocks that have been driving market returns for the last while. Earnings growth estimates for those companies are going up, not down. If they've been growing at 20, next year the market expects them to go at 30. NVIDIA, for example, it's been growing at 50% over the last 5 years. Tremendous, okay? But if you look at analyst estimates, they think it's going to accelerate to something like 70% over the next 2 years. So if they don't deliver on those tremendous expectations, I think there's huge scope for disappointment. And that's why I'm saying the market can come off by 15 or 20% without too much difficulty. Yeah. And that's why I'm cautious.
And Henry, the last thing that hangs over the market all the time is interest rates. I mean, there is a question which I'll deal with separately in terms of why South African interest rates came down such a small amount. But do you see American interest rates continuing? Do you think we'll still get more cuts in the next 2 months?
Yeah, I do. I mean, this last kind of unemployment report means that you won't get a big cut at the next meeting, but they're certainly heading downward. And, there are two camps of thought. One is they've achieved a soft landing, and the second camp think that the hard landing is still coming. I probably have 1.5 feet in the latter and 0.5 foot in the former. So, I'm cautious.
Okay, let's get some emails. There's one from Gareth in Hoedspruit, and he says, why interest rates are high? After all, inflation in South Africa is pushed on us and not driven by demand. By the way, I agree with Gareth completely. I was absolutely shocked that our interest rates only came down by 0.25%. And I know we may have a lot of economists, fortunately they can't call me on TV this evening saying, I don't know what I'm talking about, but I understand, I'm out there with the public. I understand the two-pot system where people are taking money out of their pension funds because they're short of money. And people who are taking money out of the pension funds are not people who don't earn. They earn, they can put bread on the table, and they're short. So why didn't we come down with more of a rate cut than 0.25%? I mean, that's 17 Rand in 100,000 Rands worth of debt saving.
Yeah, so if you remember, I remember asking this question, and Kuben Naidu, who was then at the Reserve Bank, said, "Look, guys, you need to remember that a lot of the inflation in South Africa is currency driven. It's driven by the weakness of the rand. So when we sit around the table, we need to think about how to defend our currency." So, he doesn't necessarily, he wants to make sure that the rand doesn't get weaker. Or at least he wants to make sure the rand doesn't get too weak too quickly, and that's why they tend to lag interest rates cuts on the way down, because I think they're thinking about inflation, but also making sure that they limit currency-driven inflation.
Okay, well, maybe I just don't understand it, but I can tell you that in my view, people in South Africa need lower interest rates. They need to be able to live. Tikin Rondebosch says, I'm invested in one of Anchor's funds, which is made up of quite a few shares. Is it not more sensible to buy an ETF?
Yeah, look, I mean, this is ultimately a decision between active and passive management. And I always think that the right approach is a blend of the two. There will be times when active managers outperform and times when they underperform. I think the South African market is a great example. So this year, I think the JSE All Shares up 15%. Some of the better active managers are up 25%. So I think the answer is to have a bit of both in your portfolio.
Okay, and then Philip in Greenside said, what must happen in South Africa for foreigners to overweight in our markets?
That's a great question. So generally speaking, when risk sentiment is positive, you see net inflows into emerging markets. So that in a risk-on environment where fund managers are keen on taking on more risk, they'll invest into emerging markets, including South Africa. When there's a risk-off environment, you'll see the opposite. You'll see an outflow of money from markets like South Africa. So over the last couple of months, you've seen net inflows. Our equity market's been a net beneficiary. So it's mostly global risk sentiment, and that kind of hangs on what's happening in the world's biggest economies, in America, in China, and to a lesser extent in Europe. So unfortunately, we're kind of like a cork in the ocean, where we're really at the mercy of the flow of the tides.
Because, Henry, there are two things that we still got. However euphoric South Africa is, our GDP is dismal. And unemployment, there's nothing we're doing about unemployment at this point in time. Surely a foreigner investing in our market is going to not just look at the green shoots, but rather look at how is our economy going to actually grow.
Yeah, and that's a fact. I mean, if you have a look at what the JSE's done in dollars over the last decade, it's a pretty sad story. So what's the important question to answer is, where are we on the sentiment kind of gauge, and where do things go from here? And you could argue that we're still at a relatively suppressed level on the sentiment gauge, and looking forward, incrementally, I think things are getting better. So I think there's upside to our equity market in dollars.
So Henry, Sam in Belita says, how do you feel about structured products? But there's another question before I came on air that he phoned me on, and he said, easy enough about structured products, but really, if our growth levels aren't there, surely that's going to hold back foreign investors, because nothing is coming into South Africa that is actually creating jobs. We talk about our bond market, we talk about equities. So maybe the two questions, the first one is, if nothing happening in our economy, if foreigners are not investing and creating jobs, where to from here?
Yeah, so look, I mean, make no mistake, I'm not painting out a kind of a Goldilocks scenario for South Africa over the next 12 months. I think things are getting incrementally better. But now we're talking about FDI, foreign direct investment. That's investment in assets and people and operations on the ground in the country. That's going to be driven by what happens in government, policy stability, empowerment policy, this labor stability. I mean, I know that our top executive team in government has been overseas recently, marketing a package of investments. I think they're doing a good job. To the extent that the GNU proves to be relatively stable over the next 12 months, I think you'll start to see more direct investment coming through. So again, at the margin, I think we'll see growth. But like I said, we're coming off a very suppressed level. So you want to see that kind of incremental improvement sustain over the next 2, 3, 4, 5 years.
And his other question about structured products, many people don't understand structured products is where you buy an index, you get a 3 or 5 year investment. If the index does certain amount of performance, you'll get that benefit, but you've got capital protected. Henry, how do you feel about structured products?
Clients like simplicity, and that's what structured products give you. They tell you exactly what you're investing in. They generally give you a little bit of a barrier of protection, sometimes between 30 or 40%. So in other words, if what you're investing in goes down by 30 or 40%, you don't lose any money. And then provided that underlying index or share goes up or stays sometimes even flat, you earn a predefined return. There's no mark-to-market volatility, so the value of that investment doesn't change until it expires, and then at the expiry date, you get your return, or you get nothing, or you take a loss if you've broken the barrier on the downside. So it's not a free lunch. That's the important point to make. But it does limit the volatility you experience as an investor, and the outcome is fairly easy to predict if you're watching the price of the underlying investment. So I don't think you must throw your whole portfolio at it. Okay, it's not a magic formula. I think there's a place for it in your portfolio.
Yeah, I think, Henry, from an investment point of view, everything we've spoken about is not an or, it's an and. All these concepts we've spoken about, being and here, and you South Africa, and offshore, and all these things are an and. It's not, do I do one or the other? There's balance in your portfolio. Nadir Hillcrest says, when will we know whether the AGOA arrangement has been renewed, and what will happen if it's not renewed?
Yeah, so, I've chatted to economists who are a lot smarter than me on this subject. And basically, whether or not those concessions continue is kind of negligible at an SA economy level. What's far more significant is our status with the WTO, and those concessions are far more meaningful for us, and we won't lose those if AGOA falls to pieces. So I think while it tends to make headlines, and a lot of the senators in the US tend to get a little bit aggro about it, investors on the ground in South Africa really don't need to worry about it.
Well, I'm going to skip some of the emails I got here because I wanted to ask you just one last question before we go off air. And it says, it's from Evelyn in Durbanville. She says, okay, I can't even take this, Henry. I'm sorry to Evelyn, and I'm also sorry to Brett in Craigwell Park. I'll give you a call and answer your questions. Look, I expect quite a lot of volatility going forward in both the equity and possibly our bond markets. And only a genius or a fool can predict where the rand is going. As I close tonight's program, I'll put on my dunce's cap and retreat to a corner rather than try and predict the rand movement in the long term. I'd like to thank Henry for joining me this evening. It's important to note that our program tonight is to provide information and should not be construed as advice. Next week's program, we'll be dealing with financial and investment retirement planning, and if you need to get hold of me, my details will appear on the screen. Thank you for watching, and good night.